When the world is distracted by headlines, smart money pays attention to what is happening beneath the surface. Right now, the silver market is sending signals that most investors are completely missing. Governments continue printing money, industrial demand is reaching record levels, and physical silver supplies are becoming tighter than many realize. Yet the mainstream conversation remains focused elsewhere. History has shown that the biggest wealth building opportunities appear just before the crowd finally notices them. The question isn't whether silver can move, it's whether you'll recognize the opportunity before the price leaves everyone behind. In today's speech, we're going to uncover why many seasoned investors believe silver could be approaching one of the most explosive moves in modern history, what powerful forces are driving this market, and why the information you're about to hear could completely change the way you think about precious metals. When investors talk about explosive moves in financial markets, the conversation often begins with excitement and ends with disappointment because emotions tend to replace careful analysis. Silver has experienced dramatic rallies throughout history, but every significant move has been driven by a combination of economic forces rather than a single headline or isolated event. Understanding those forces is what separates informed decision making from speculation. Instead of asking whether silver is guaranteed to rise, a more useful question is whether the current environment shares characteristics with previous periods when silver attracted increased attention from investors, manufacturers, and institutions. Looking beneath the surface reveals a market influenced by far more than daily price fluctuations. Silver occupies a unique position among commodities because it serves two very different purposes at the same time. It is both an industrial metal and a precious metal. This dual identity creates a market unlike gold, copper, or most other raw materials. During periods of economic expansion, manufacturers require silver for electronic solar panels, medical equipment, automotive components, and countless technological applications. During periods of economic uncertainty, investors often view silver as a tangible asset that can diversify a portfolio alongside gold. These two sources of demand do not always move together, but when they begin reinforcing one another, the market can experience heightened volatility. Industrial demand has become one of the most closely watched aspects of the silver market. Modern technology depends on materials that offer excellent electrical conductivity, thermal conductivity, and resistance to corrosion. Silver performs exceptionally well in these areas, making it difficult to replace in many specialized applications. As industries evolve, engineers continually search for ways to improve efficiency while controlling costs. And although manufacturers sometimes reduce the amount of silver used in individual products, the overall growth in production can offset those savings. The result is a complex relationship between technological innovation and material consumption that influences long-term demand. Renewable energy has also become an important factor. Solar photovoltaic panels require silver in their electrical contacts, and as countries invest in expanding renewable energy infrastructure, this sector has contributed meaningfully to industrial demand. However, the relationship is not as simple as higher solar installations automatically leading to higher silver prices. Manufacturers continually work to reduce silver usage per panel, while recycling efforts and broader economic conditions also affect supply and demand. Understanding these competing influences is more valuable than relying on simplified narratives. On the supply side, silver production presents its own challenges. Unlike some commodities that are mined primarily for their own value, a significant portion of global silver production comes as a byproduct of mining for metals such as copper, zinc, lead, and gold. This means silver supply is not determined solely by silver prices. Even if silver becomes more valuable, production may not increase immediately because mining companies make decisions based on the economics of their primary metals. This characteristic can create periods when supply responds more slowly than market participants expect. Mining itself is a long-term business. Discovering economically viable deposits, obtaining permits, securing financing, constructing infrastructure, and beginning commercial production often require many years. Environmental regulations, community engagement, geopolitical developments, labor availability, and operational costs all influence the pace at which new production reaches the market. These realities remind investors that commodity markets rarely change overnight simply because prices become attractive. Physical inventories are another area frequently discussed. Inventories held by exchanges, refiners, manufacturers, and private investors help balance temporary differences between supply and demand. When inventories decline, some analysts interpret this as evidence of tightening market conditions. Others point out that inventory levels alone cannot explain future prices because they must be considered alongside industrial activity, recycling rates, imports, exports, and broader economic expectations. Looking at one indicator in isolation rarely provides the full picture. Investor sentiment can also play a powerful role. Financial markets are influenced not only by measurable data, but also by expectations. If investors collectively believe that inflation may rise, economic uncertainty may increase, or currencies may weaken, interest in precious metals often grows. Exchange-traded funds, futures markets, and physical bullion purchases can all reflect changing sentiment. Yet sentiment is dynamic. It can strengthen rapidly during periods of optimism and fade just as quickly when conditions change. Interest rates deserve particular attention because they influence the attractiveness of assets that do not generate income. When real interest rates rise, investors may prefer income-producing investments such as bonds. When real rates fall or become negative after adjusting for inflation, precious metals sometimes become more attractive as stores of value. This relationship has appeared repeatedly in financial history, although it is never the only factor affecting prices. Inflation itself is another subject that attracts significant discussion. Rising consumer prices often encourage investors to explore assets perceived as preserving purchasing power. However, silver's response to inflation has varied across different economic cycles. In some periods, it has outperformed expectations, while in others, broader market conditions, monetary policy, or slowing economic growth have limited gains. This reminds investors that historical relationships offer context rather than certainty. Currency movements also influence commodity markets because silver is generally priced internationally in US dollars. A stronger dollar can create headwinds for commodities by making them relatively more expensive in other currencies, while a weaker dollar may support demand under certain conditions. Exchange rates, however, respond to a wide range of global economic developments, making their impact difficult to isolate. Market psychology often magnifies these underlying fundamentals. Periods of optimism can encourage new participants to enter the market, increasing trading volume and volatility. Conversely, fear can accelerate selling even when long-term fundamentals remain largely unchanged. Experienced market observers recognize that prices frequently overshoot in both directions as emotions temporarily dominate rational analysis. Understanding this tendency helps investors interpret sharp price movements with greater perspective. Another important consideration is diversification. Many experienced investors view silver not as a guaranteed path to exceptional returns, but as one component of a broader investment strategy. Diversification seeks to reduce overall portfolio risk by spreading exposure across different asset classes rather than relying on a single outcome. Whether silver ultimately performs well depends on numerous interconnected variables, including economic growth, industrial production, monetary policy, investor confidence, geopolitical developments, technological innovation, and global trade patterns. Historical episodes demonstrate that strong commodity markets rarely emerge from one isolated event. Instead, they tend to develop through the interaction of multiple forces that reinforce each other over time. Supply constraints, changing industrial demand, shifting monetary policy, evolving investor expectations, and broader macroeconomic conditions all contribute to the environment in which prices move. Recognizing these relationships encourages a more disciplined approach than reacting to sensational headlines or dramatic predictions. The most valuable signals are often found not in a single statistic, but in the broader pattern created when numerous indicators begin pointing in the same direction. Discussions about silver often include claims that the market is facing a hidden shortage, but understanding what that phrase actually means requires looking beyond headlines. Unlike many consumer products, silver moves through a complex global supply chain that includes mining companies, refiners, manufacturers, wholesalers, exchanges, bullion dealers, investors, and recyclers. Each participant sees only part of the overall picture, which is one reason different analysts can reach different conclusions from the same publicly available data. The first point worth understanding is that shortage can mean different things depending on the context. An industrial manufacturer may describe a shortage as difficulty obtaining a specific form or purity of silver on short notice. A retail investor may view a shortage as local coin shops running low on popular bullion products. A commodity exchange may still have registered inventories available for delivery even while certain products experience temporary delays. These situations are related, but they are not identical, and treating them as the same can lead to misunderstandings. Global silver supply comes from several primary sources. The largest is mining production, which accounts for most newly available silver each year. However, a substantial share of global silver output is produced as a byproduct of mining for metals such as copper, lead, zinc, and gold. This characteristic makes silver different from commodities whose production responds more directly to their own market price. If demand for copper weakens, for example, production decisions by copper miners can influence silver supply even if silver prices remain relatively strong. Mining is also a long-term industry. Developing a new mine involves geological surveys, environmental studies, financing, engineering, permitting, construction, and years of operational planning. Even when companies identify promising deposits, bringing them into commercial production is rarely a quick process. This means that changes in supply tend to occur gradually rather than immediately, especially when compared with changes in investor sentiment or financial market activity. Recycling represents another important source of supply. Silver can be recovered from industrial scrap, jewelry, electronics, photographic materials, and other products. The amount recovered varies depending on technology, collection systems, processing costs, and market prices. Higher prices may encourage additional recycling, but not every product contains enough recoverable silver to make the process economically attractive. Improvements in recycling technology can increase available supply over time, although they rarely eliminate the need for newly mined metal. Demand is equally diverse. Industrial consumption represents a major portion of annual silver use. Electronics manufacturers rely on silver because of its excellent electrical conductivity. Renewable energy industries use silver in photovoltaic cells for many solar panels. Medical applications, chemical catalysts, specialized alloys, and numerous other products also depend on silver's unique physical properties. At the same time, investors purchase coins, bars, and exchange traded products, creating another layer of demand that can fluctuate with economic conditions and market sentiment. Because these different forms of demand respond to different economic forces, the overall market can be difficult to interpret. Industrial buyers may reduce purchases during a slowdown in manufacturing, while investment demand increases because of uncertainty in financial markets. Alternatively, strong economic growth can boost industrial consumption even if investor interest in precious metals declines. Understanding these interactions requires looking beyond a single indicator. Exchange inventories frequently receive attention in discussions about market tightness. Commodity exchanges publish information about metal held in approved storage facilities, and analysts often monitor changes in these inventories for signs of shifting market conditions. Declining inventories may suggest that more metal is leaving storage than entering it, but inventory changes alone do not prove that the global market is running out of silver. Metal can move between exchanges, private vaults, industrial users, refiners, and international markets for many reasons. Retail availability offers another perspective, though it should not be confused with global supply. During periods of unusually strong investor demand, coin dealers may temporarily run out of certain products, and premiums over the spot price can increase. These events often reflect bottlenecks in manufacturing, transportation, or distribution rather than a complete absence of silver. Producing finished bullion products requires refining, fabrication, packaging, and shipping, all of which have capacity limits that can affect availability even when raw silver remains accessible elsewhere in the supply chain. Premiums themselves provide useful information. The spot price represents the market value of unfabricated silver under standard trading conditions, while retail buyers usually pay additional costs for minting, distribution, insurance, dealer operations, and market demand. During periods of heavy buying, premiums may rise significantly even if the underlying spot price changes only modestly. This distinction illustrates why different parts of the market can behave differently at the same time. Some analysts point to persistent annual supply deficits, where total demand exceeds newly mined production and recycling combined. Such deficits can be important, but they do not automatically imply that prices must rise immediately. Existing inventories accumulated over previous years can help bridge temporary imbalances, and market participants continuously adjust purchasing decisions, production schedules, and inventory management in response to changing conditions. Commodity markets often absorb supply-demand imbalances over extended periods rather than through sudden price adjustments alone. Technological change also influences both supply and demand. Manufacturers continually work to reduce the amount of silver needed in each product without sacrificing performance. This process, sometimes called thrifting, has reduced silver use per unit in certain applications over time. At the same time, expanding production of electronics, renewable energy equipment, and other technologies can offset these efficiency gains through higher overall output. The balance between improved efficiency and growing production remains an active area of analysis for market observers. Another factor involves geopolitical developments. Mining operations are concentrated in several regions around the world, and political changes, labor disputes, environmental regulations, weather events, or infrastructure challenges can affect production schedules. These disruptions may temporarily influence regional supply, although the global market often adapts through trade flows, inventory management, and adjustments by producers and consumers. Financial markets add another layer of complexity. Futures, contracts, options, and other derivatives allow participants to manage risk or express views on future prices without necessarily taking immediate physical delivery of silver. Supporters argue that these markets improve liquidity and price discovery by bringing together buyers and sellers from around the world. Critics sometimes contend that financial trading can amplify short-term price movements or create disconnects between paper markets and physical demand. Economists continue to debate the extent to which these mechanisms influence long-term pricing, making it important to distinguish established evidence from ongoing discussion. Professional analysts rarely rely on a single metric when evaluating silver. Instead, they examine mine production, recycling volumes, industrial activity, investment demand, exchange inventories, fabrication trends, macroeconomic conditions, interest rates, currency movements, manufacturing data, and global trade patterns together. Each indicator provides only one piece of a much larger picture, and interpreting that picture requires acknowledging both supporting evidence and remaining uncertainties.